The United States housing market, boasting a staggering value of $45 trillion and comprising over 140 million residential units, stands as the largest and most critical market on a global scale. However, it is alarming to consider that this behemoth market is presently hovering precariously close to the edge of calamity with the capacity to propagate shockwaves throughout the worldwide economy. Should this monumental market disintegrate, the consequences would be far-reaching, and the groundwork of this colossal industry is beginning to demonstrate signs of weakening, with the potential for its imminent downfall to generate reverberations across the planet. Hi everyone, this is UpThink. If it is your first time here, welcome, and do not forget, you can click the subscribe button and hit that notification bell for more educational videos from us. For today, we are going to be discussing the US housing market crash and what we should expect currently. Let us delve into the concealed hazards lurking within the United States housing markets and explore the extensive implications of its potential implosion in recent years. The U.S. housing market has undergone an unparalleled expansion, with home values skyrocketing to unprecedented levels in numerous cities. The combination of fluctuations in interest rates, the limited account of housing, and a surge in demand have propelled this growth, causing experts and prospective buyers alike to ponder whether a major correction is imminent. Indeed, certain cities have already witnessed a substantial decline in housing prices, with drops as high as 25%, which indicates that the market may be on the brink of disruption. Much like the 2008 financial catastrophe, the imminent crisis in the housing market has emerged as a pivotal issue of discussion in the financial realm. The repercussions of a housing market collapse could have significant implications for the wider economy, with mortgage rates and home prices in certain regions showing erratic behavior while remaining stubbornly high in others. With the likelihood of a nationwide market crash growing more plausible by the day, it is imperative for investors, potential homeowners, and policymakers to comprehend the driving forces propelling the U.S. housing market toward this potential implosion. In recent years, the United States housing market has witnessed an extraordinary surge, with soaring prices, historic low interest rates, and a dearth of available housing stock. In several cities, double-digit price hikes have ensued due to a surge in demand and an influx of investors purchasing properties. Nonetheless, there are mounting apprehensions that these factors have contributed to a housing bubble that is perilously close to bursting. A multitude of indicators points to an imminent downturn in the housing market. To begin with, the National Case-Shiller Index has indicated a decline spanning 6 to 8 months, a trend that has not been witnessed since 1987. Furthermore, cities such as Seattle have witnessed a decrease in prices exceeding 15%, which is reminiscent of the 2008 financial crisis. Meanwhile, the Federal Reserve has commenced increasing interest rates, thereby elevating the cost of borrowing and diminishing the demand for homes. The mounting presence of investors is a crucial factor contributing to the impending collapse of the housing market. As institutional investors and affluent individuals purchase properties, they are raising up prices and curtailing the availability of affordable housing for ordinary buyers. The surfeit of investment capital has rendered it arduous for first-time home buyers and those with lower incomes to compete, resulting in an escalating affordability crisis. While the COVID-19 pandemic is gradually receding, it has profoundly influenced our work dynamics. With numerous corporations embracing work policies, this transition has resulted in a surge in demand for larger homes and work-friendly spaces conducive to remote work, exacerbating the pre-existing competitive housing market. As remote work continues to gain traction, the demand for housing in suburban and rural regions may persistently soar, further straining the market. Compounding this predicament is the risk of a widespread affordability crisis as housing prices continue to escalate while wages fail to keep pace with the rapid surge in home prices. Within a brief half-year period, the market has experienced an extraordinary loss of $2.3 trillion in value, resulting in considerable financial strain for homeowners. The root cause of this unparalleled downturn and its prospective outlook is a subject of much inquiry. Redfin reports that this is the largest drop since the notorious subprime mortgage crisis of 2008. However, this time the main perpetrator is higher interest rates, which have triggered a decrease in demand and caused the median home prices to nosedive by 11.5% from their peak in May. The uptick in interest rates has resulted in a decline in demand for homes, which has left many potential homebuyers unable to afford homes. This has led to a significant drop in U.S. home purchase applications, with cities such as San Francisco, Oakland, and New York being the hardest hit due to pandemic-induced tech layoffs and high prices. Despite the current downturn, Redfin economist Chen Zhao suggests that homeowners who have benefited from the pandemic housing boom will still enjoy the benefits, as the total value of homes remains significantly higher than before the pandemic. However, it is expected that home prices will continue to fall. Kieran Clancy, an economist at Pantheon Macro, is forecasting a significant drop in home prices due to the sharp decline in existing home sales, which have fallen nearly 40% from their pandemic high. According to Pantheon's projections, home prices will decrease by 20% from their peak by the end of 2023, potentially resulting in a further 10% decline in median prices to around $346,500. However, Comerica Economics has a more moderate outlook and predicts that average prices may fall by up to 9% nationwide. The recent housing market downturn in the U.S. serves as a clear reminder that the market is exposed to external influences, including economic policies and interest rates. As individuals involved in the housing market, whether as buyers, sellers, or homeowners, it is vital to stay up to date with the current state of affairs and be prepared for any potential challenges that may arise in the future. So we have talked about the apparent fundamentals of why there could be a possible collapse in the housing market. But what could likely be the results of a housing downfall? Number 1. General economic slump. The collapse of the housing market can have extensive ramifications on the broader economy, which could result in a significant reduction in consumer spending and confidence. As the value of homes decreases, households may feel less affluent and as a result may become more cautious with their spending. This can have an adverse effect on various industries such as retail, automotive, and travel. In addition, the construction sector, which heavily relies on a thriving housing market, may face significant job losses and reduced investments in new projects. The financial sector may also suffer as banks and lending institutions deal with a growing number of delinquent loans in non-flexible credit conditions. This ripple effect has the potential to cause a recession, which would further strain the job market and amplify the financial distress experienced by households. Number 2. Lasting effects on geography and social sense. If the housing market crumbles, it can have some serious and long-lasting effects on society and where people live. With affordable housing becoming more scarce, people may be forced to leave high-priced urban areas and search for cheaper options. This could cause a big change in where people live, with cities losing people and rural areas getting more residents. This could put pressure on local infrastructure and public services like schools, hospitals, and transportation. Additionally, those with lower incomes could be hit hardest by the housing crisis, making it tough to get good jobs and widening the gap between the rich and the poor. Number 3. Significant dissatisfaction. In the event of a collapse in the housing markets, one of the most visible and immediate consequences would be a surge in negative equity and foreclosures. Homeowners who bought properties at the peak of the market would be particularly vulnerable to negative equity, where the value of their homes is less than the outstanding mortgage balance. This could make it difficult for them to sell or refinance their homes, leaving them trapped in a property that is no longer a good investment. As home prices continue to fall, homeowners may struggle to keep up with mortgage payments, leading to a surge in foreclosures. This would result in a glut of distressed properties on the market, further driving down home values and exacerbating the housing crisis. As the U.S. housing market displays signs of an impending collapse, it is crucial for prospective home buyers, investors, and policymakers to remain watchful and be well prepared in order to avoid a repeat of the haunting scenes from the 2008 housing market crash. During the period, houses were selling like crazy, loans were being handed out without due diligence, and the economy seemed indestructible until the bubble burst and the housing market was plunged into chaos. The story of the 2008 housing crisis started with a bang. During the early years of the 2000s, the U.S. housing market witnessed unprecedented growth, bolstered by low interest rates, lax lending standards, and an air of expectation that suggested home prices would keep soaring indefinitely. As a result, people were frantically buying and selling properties, leading to an increase in prices and the creation of a bubble that appeared too good to be true, and eventually proved to be so. The root of the housing crisis lay in the subprime mortgage market, which allowed lenders to offer mortgages to borrowers with less than ideal credit in order to capitalize on the booming housing market. These subprime loans typically came with adjustable interest rates that started low but could quickly become unmanageable, making it difficult for borrowers to keep up with payments. The situation was exacerbated as more and more of these subprime loans were packaged and sold as mortgage-backed securities. Trouble started emerging in 2007 as the number of foreclosures rose due to borrowers defaulting on their subprime loans. As the subprime mortgage market crumbled, a sense of alarm gripped the investment community. Doubts about the viability of mortgage-backed securities began to spread, which resulted in a rapid decline in their prices. The fallout extended beyond the financial sector and destabilized several major banks and institutions, including Bear Stearns and Lehman Brothers. The ripple effects of the crisis were felt throughout the U.S. economy, and the stock market plummeted. In response, the U.S. government stepped in, providing financial support to keep the struggling financial institutions afloat. But this controversial move was met with widespread public discontent. Despite the criticism, the bailout was deemed necessary to prevent the entire financial system from collapsing. The ramifications of the 2008 housing crisis were significant, extending beyond the United States and affecting countless individuals worldwide. Many Americans were impacted by the crisis, losing their homes, employment, and savings as the economy deteriorated. The global economy was also shaken as the crisis reverberated throughout financial markets and institutions, causing widespread concern and instability. Ultimately, the 2008 housing crisis serves as a reminder of the dangers of unchecked lending practices and the need for greater oversight and regulation in the financial sector. In the aftermath of the crisis, policymakers took steps to prevent a recurrence of the events that led to the catastrophe. They implemented more stringent lending standards and subjected the financial sector to greater supervision and examination. These measures helped to mitigate some of the risks and vulnerabilities that contributed to the housing market collapse. Nevertheless, the effects of the crisis linger on, serving as a poignant reminder of the perils of unbridled avarice and conjecture. The big question now is whether history is repeating itself. Recent events have certainly drawn parallels with the 2008 crisis, but it seems that policymakers are taking appropriate measures to prevent a similar catastrophe. In 2008, banks played a major role in the crisis, and the recent collapse of Silicon Valley Bank has sparked concerns among investors. This unexpected development has sent shockwaves through the real estate industry, causing builders and agents to scramble to assess its impact on mortgage rates and the economy as a whole. Zillow's top economic expert, Skylar Olson, recently shared some thoughts about the impact of Silicon Valley Bank's downfall on the U.S. housing market in 2023. Olson suggested that one likely result of this crisis is a decrease in mortgage rates. If the Federal Reserve decides not to raise rates, which was expected not long ago, mortgage rates could continue to fall. The financial markets have already caused the average 30-year fixed mortgage rate to decrease to 6.75% from last week's high of 7.05%. If this trend continues, it would be a relief for home buyers, particularly in expensive areas. Nevertheless, if the collapse of the bank indicates an approaching recession, the advantages of lower mortgage rates might be outshone by the economic chaos. In the wake of Silicon Valley Bank's collapse, one possible consequence is the heightened pressure on housing markets dominated by the tech industry, such as San Francisco and Boise. These areas are already grappling with the effects of the Federal Reserve's efforts to curb inflation, and the bank's downfall could worsen the situation, exacerbating pre-existing difficulties. In the event of a broad-based decline in the tech industry, real estate markets that depend on tech jobs and stock prices could experience a cooling effect, resulting in declining prices as fewer buyers are able to afford the high costs associated with these areas. Amidst the current situation, buyers and sellers in tech-centric regions, as well as nationwide, may encounter some difficulties. Although a temporary drop in mortgage rates may bring short-term relief to home buyers, they need to be wary of the long-term risks that come with potential economic instability. To safeguard themselves, buyers should prioritize purchasing homes that they intend to hold on to for a longer period, giving themselves enough time to accumulate equity in case the housing market experiences any turbulence. It is evident that with such uncertain times ahead, remaining well-informed and making well-thought-out decisions will be key in weathering the housing market's future storm. But let us calm down and have a break from all the negatives. Although the current state of the housing market seems bleak, there are some promising indications that we may avoid a crash despite the risks at hand. Let us take a look at some of the reasons why the current housing market may be more stable and resilient compared to the situation before the 2008 financial crisis. Number 1. Scarce housing stock. The current housing market stability can be attributed to the low inventory of homes available for sale, which is a significant departure from the period before the 2008 crash. Unlike the oversupply of homes on the market at that time, the demand for housing currently exceeds the supply, leading to a competitive market and higher home prices. This scarcity of available homes helps to bolster home values, reducing the likelihood of a sudden drop in prices. Number 2. A robust labor market and economic expansion. The soundness of the economy and labor market is another significant aspect supporting the steadfastness of the housing market. Low unemployment rates and constant economic expansion enable people to earn stable incomes, which in turn reduces the risk of mortgage payment defaults and allows them to afford home payments. A robust job market also leads to the creation of new households, which increases the demand for housing. Number 3. Local marketplaces are varied and stable. The U.S. housing market is not a monolithic entity, but a collection of various local markets, each with its own distinct qualities and patterns. Though certain regions may encounter price variations or regional recessions, the housing market in general is more robust than it was prior to the 2008 crisis. Several cities and areas have thriving local economies, expanding job opportunities, and population growth, all of which contribute to the strength of their housing markets and alleviate the possibility of a nationwide collapse. Number 4. Tighter lending policies and restrictions. The 2008 housing market crash was largely due to the abundance of subprime mortgages and loose lending practices. Nowadays, lending institutions have implemented more stringent regulations and underwriting standards, making it harder for unqualified buyers to get mortgages. Borrowers must now have better credit scores, make higher down payments, and thoroughly document their income and assets. These enhanced lending practices ensure that homeowners can afford their mortgage payments, decreasing the chances of widespread defaults and foreclosures. Number 5. Cheap mortgage interest rates. The prolonged period of historically low mortgage rates is providing an opportunity for more people to join the housing market thanks to lower monthly payments. This affordability makes it possible for buyers to keep up with mortgage payments, ultimately stabilizing the market and minimizing the risk of a market crash due to a surge of defaults. In conclusion, although the housing market can be unpredictable, the present situation indicates that we are not in the midst of another crisis comparable to the one witnessed in 2008. Factors such as stricter lending standards, scarce housing stock, low mortgage rates, and a robust job market all contribute to the housing market's stability and resiliency. Additionally, the various unique local markets across the United States, with their diverse characteristics and trends, provide additional safeguards against the possibility of a nationwide crash. Although there is reason to be optimistic about the current stability of the housing market, it is still necessary to keep a watchful eye on market developments. While the risk of a housing market collapse like that experienced in 2008 is low, it is still present, and the coming months will be pivotal for the industry. Investors, builders, and home buyers alike must approach the current climate with caution and make well-informed decisions to weather any potential economic turbulence. Thank you so much for watching, and we hope we were able to give you even just a little insight into what the US housing market is like nowadays. If you enjoyed it and want to share your thoughts about this, leave a like and comment down below. We love reading your opinions and are always encouraged by your support to keep making these videos. If you have not subscribed yet, go ahead and click that subscribe button below because we have so much more exciting content heading your way. We hope to see you again in the next video. Bye for now.